Welcome back. You're joining us live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. We are kickstarting a brand new week. In just minutes from now, we'll get the pre-opening rates. And it looks like it's going to be quite a volatile start amidst all the headlines that we're getting globally. But let's also drill it down to individual stocks. This is our Momentumizer segment. And my colleague Surbhi is joining in to tell us about NCC that she's looking at this morning. Surbhi, over to you.
The stock on my radar today is NCC. In the last 1 year, it has had a stellar performance. In the last 1 week, it was up 4%. In the last 6 months, it is up 46%. And in the last 1 year, it has been up 68%. The delivery and the traded volumes are also pretty strong. The delivery quantity was 1.9 times the 5-week average last week. And the traded quantity was 2.1 times the 5-week average last week. Now, some other key triggers that will work in the favor of the stock is it has a very robust order book. In Feb itself, it has won 3 orders totaling up to 2,374 crores. And this is across different segments: railways, mining, water and environment. And it also plans to reduce debt by 200 to 300 crores in FY23 itself. So robust order book, execution capabilities and debt reduction all might work in the favor of the stock.
All right, thanks a lot for that, Surbhi. But let's get back to the market opening. The pre-opening rates are settling in the red. So, it looks like it's going to be a slightly volatile start. What's dragging this morning are a couple of these stocks. Tata Consumer is down almost 3%. Axis Bank, Asian Paints, Ultratech Cement and Power Grid are a couple of other stocks that are in the red right now. So we'll wait by for these rates to settle. It's still the initial tick, but the indications are that the start could be a cut of over 70 points on the Nifty. Dipan Mehta is still with us. Dipan, I wanted your thoughts on the Adani Group stocks because Adani Enterprises, for example, right? I mean, it's up 40% this month. I know this is a space that you are a bit cautious on, but now there's news flow that the group has put on hold its Mundra project. They've suspended their plans to raise money. Also, the projects which need more debt financing, they're not going ahead with those. Some work is being done to sort of correct, the wrongs that have been done in the recent past. So do you think from a stock market perspective, does it make sense for investors to buy now?
See, Sonia, I think you're right. You said the words corrective action has been taken. And at least I think with every passing day, some of the concerns which investors and analysts have had on the Adani Group companies, they are addressing those concerns and those fears are gradually allaying. But by and large, unless the valuation comes into a zone which we can understand and we are comfortable with, I think wouldn't advise buying into Adani Group companies. No doubt great businesses and they have done fabulous progress over the last several years or so. But then from a stock market perspective, the best company need not be the best investment. And you need to get into that zone where valuations are comfortable and there's some amount of margin of safety. Also, I'd just like to wait for how the regulatory outcome is on account of the kind of controversies which arose post the short sellers report. So that also is a bit of a risk factor from a conservative investor's perspective.
Okay, got that. Dipan, stay on. We'll have some more questions for you. Let's quickly get a conversation going specifically on the banking sector, given all the news flow. Manish Agarwala, co-head of research at Phillip Capital, is with us and he tracks this sector in great detail. Manish, good morning. Good to have you on the show today. I just want to first start up with, how you're looking at the HDFC Bank merger. In all probability, the announcements have all gone through. Our earlier guest was, for instance, saying that there is a bit of an arbitrage opportunity that can still be played. But how do you look at the combined entity and what is your current call on the two individual stocks?
Yeah, hi, good morning. Thank you for having me on the show. The merger is one of the biggest in the corporate India history. And the experience of this merger and the regulatory guide path will become precedents for the future conversion of NBFC, large NBFC into a bank. So we see the regulatory guide path very closely. We monitor that very closely. As far as the merged entity is concerned, HDFC Bank is expanding their deposit very aggressively. They are trying to be more reliant on retail deposit. At the same time, they are also trying to build up the priority sector requirement very aggressively. As a merged entity, obviously, because of the high base, there can be some moderation in the growth going forward, unlike the way HDFC Bank used to grow in the past. If you look at between 2000 and 2009, the bank used to grow at a CAGR of 24-25%. post-COVID, the growth has come down to somewhere around 18%. We foresee this growth on the combined basis to be between 14 to 15% going ahead in near term. Obviously, the moderation in the growth will have some bearing on the valuations of the merged entity, which we have already seen as of now. We are not expecting the merged entity to see the previous valuations, but at the same time, this will be one of the largest merger, and HDFC Bank will expand its footprint in terms of mortgages in other geographies, which Limited was not doing earlier, and that will also bring a lot of cross-sell opportunity. Having said that, I think we remain very positive in this name from medium to long-term perspective. But reiterating again, there is a cap on the valuation for the merged entity.
Sure. So when you say you're positive from a long-term perspective, right? This is what HDFC Bank is now at a little under 1,600 rupees. Once the merger goes through in its entirety and the stock as well reacts to what the merged entity growth parameters could look like, what do you see as the medium-term upside for the stock in terms of what's your price target?
So we see around, say, 15 to 20% upside in the medium term. So we have official target price of 1,900 for the stock.
Manish, that's on the merger. Now, because of reasons absolutely not linked to Indian banks, there's a fire sale underway in the market, right? Indian banks have been beaten down black and blue, and it's so clear that there's absolutely no correlation whatsoever, and when we have our regulators to thank for that. So in this environment, are you advising a buy on any of the bank stocks? If yes, which are your top picks?
Yeah, obviously, we are positive on the sector. Despite very strong financial performance in last 2 to 3 quarters reported by most of the banks, the stock performance has not been in line because of various reasons, what you alluded, global sell-off, and so on and so forth. Going ahead, we remain very positive on the sector. We see a very strong credit cycle for the sector. Yes, there can be some moderation on the credit growth side because of the base effect, because of because of higher interest rate. Some of the retail segment might see some moderation. But having said that, I think the path looks quite strong, the growth path. At the same time, the credit cycle is very favorable. So the credit cost for the sector as a whole, at least in the medium term, we don't see any spike there. We remain very positive on the sector. However, for next 1 year, deposit will take the center stage. So bank with a very strong deposit franchise will be in a position to support their margins. At the same time, any franchise which has got a pricing power, that should do well. That's our house call. Selectively, we like some of the top private bank like ICICI Bank in the large space, Axis Bank in the large space. Those are the 2 banks which we like at this point in time. In the mid cap space, we continue to like Federal Bank. We continue to like Bandhan Bank.
So for ICICI Bank particularly, ever since Sandeep Bakshi has taken over, of course, the bank has, had a dream run, right? And now it's overtaken HDFC Bank as well in terms of margin performance, growth, etc. What kind of an upside do you see on the stock in the near term, and what could be the growth triggers?
We see similar upside between 20 to 25% for ICICI Bank as well in medium term. I think the growth trigger for iBank would be their ability to surpass the systemic credit growth that will help them to report a very strong top line. At the same time, as I mentioned, the challenge this year will be the deposit growth and the ability to defend margins. With the higher share of retail deposit, I think is ICICI Bank in well positioned at least to defend their margin compared to other peers.
Okay, Manish, got that. Thank you very much for stopping by and giving us some perspective on bank stocks today. The pre-open is settled and the bulls will take this with both hands. We are looking at a cut of just about 0.2%, and that's a lot better than some of the Asian markets. But let's see, this is pre-open. We have a long day ahead. Good time to then go back to our technical experts for some final calls before we hit opening. So Darshan, what would you go with?
Well, I would go with Tata Consumers, buy it with a stop under 685.
And Mitesh?
Buy on DLF with a stop at 366 for targets of 395.
Okay, DLF. DLF has been in the news in the last 1 week ever since they confirmed about, the sale in their Gurugram project and the kind of phenomenal sales that they've seen. So Mitesh continues to be optimistic on DLF. But let's get Sonal in. She's going to talk about the oil and gas space. There's an interesting CLSA note. Sonal, over to you.
Thanks a lot for that. Well, here CLSA is talking about how the LNG prices, they have fallen. In fact, they've halved from the December 2022 peak. Now they are at $14 per MMBTU. Remember, back in 2020 or 2021, they were around $45 per MMBTU as well. So there has been a sharp fall for sure. And this is a clear positive for most Indian gas names. So the likes of IGL, MGL, Gujarat Gas, which were seeing higher margin pressure because of higher spot LNG prices, will see stronger margins in Q4. Also, additionally, Indian gas or LNG demand, it has improved 2 to 3% on a month-on-month basis, which means there are more imports coming in at lower prices as well. And this higher demand, according to CLSA, should also drive a volume recovery in Q4 for the other utilities, GSPL, Petronet LNG, and GAIL as well. In fact, for GAIL, they say that the tariff order is likely to come out within 2 weeks itself. It is an expectation of a 50% hike for GAIL's unified tariffs, and that will be a big trigger for the stock. So they are positive on gas utilities and gas infrastructure players in the stock market as well.
Okay, all right. Thanks a lot for that. So now, well, Abhishek is joining in to revise Canfin Homes. They've got a new boss at the top. Abhishek?
Well, after a long time, you are seeing a new boss at the top at Canfin Homes. So it was in October that the earlier MD had left, and now we are seeing a new hiring being done. So they have appointed Mr. Suresh Iyer as MD and CEO of Canfin Homes. His tenure is of 3 years, which can be extended by 2 years. This was largely anticipated by many on street with respect to Suresh Iyer coming in to head Canfin Homes. So Suresh actually comes from Bandhan Bank, where he was heading the housing finance business. Not to forget the fact that, he was earlier in the GRU core management. So over there also, he has a lot of expertise in the housing finance sector. One other fact is that the biggest challenge for Suresh, however, will be, retaining the talent and getting new talents on board, because many of the, employees have actually left for a peer company on account of the better wages that they have received. Back to you.
Okay, thanks a lot for that. By the way, the start looks like it's not going to be good. It will be a downtick of about 35 odd points. At least that's what the Nifty is indicating at the start of trade. Then it's going to be pretty volatile from there. A lot of pockets, whether it's consumption, steel, autos, it's a secular move on the downside this morning. And also, if you look at it, some tweets coming in actually from Uday Kotak this morning, where he speaks about how Credit Suisse selling to UBS for $3 billion, which is a 60% discount to its stock value at Friday closing. A $600 billion balance sheet sold for $3 billion equity value. So he speaks about the 81 bonds being written off and the ramifications that would have. Also talks about how this is a signal for all bankers and stakeholders when risk-return matrix is overtaken by obsession with size. So it's not done just yet. Looks like there could be a lot of damage.
Just
done.
watching all of this play out, Sonia, I was just thinking we have a lot to be thankful and grateful for, whether it is Indian bankers or Indian central bankers or regulators, because in a span of 20 years, we've seen the same tape play out twice. It's banks, risk-taking, and I don't want to get into the morality argument of this, greed, fear, all of that. But the fact is that, you have this going on, and then you have taxpayer bailouts, and then, life just kind of goes on.
Just a quick word on the pre-open. You have stocks like JSW Steel, Kotak Mahindra Bank, you have SBI Life. Just pull up the pre-open rates out there. They're showing a very, very, sharp downtick, but the volumes are very, very less. So we're waiting for some confirmation. But it appears the volumes are very, very low, and these stocks are down 4 to around 6%. So some inputs that we're getting are indicating maybe there is some kind of glitch in the pre-open punching.
Yeah.
So select clients out there, and some of them have written to us. We're waiting for the exchange to clarify on this. But the volumes are low, and these stocks are down frontline Nifty stocks. So I said we'll just point that out.
Okay, well, just getting ready for the market opening. It's a very important week for central banks. So not just the US Fed, but a whole host of other central banks globally are also going to be meeting this week. So lots of news flow to track. And as we begin the week, the start is expected to be in the red. Remember, the global handover was on the weaker side as well. The Dow is down almost 400 points on Friday. And here's the first take on the Indian markets not looking good. 79, 80 points lower now on the Nifty. Almost 90 points gone, so there's definitely a lot of caution in the system. Now 100 points gone on the Nifty and 360 points gone on the Sensex, falling pretty rapidly on the exchanges now. The Bank Nifty is down about 300 odd points and looks like, the pressure is getting deeper. The advanced decline ratio has also opened in favor of declines at over 400 stocks on the declining side. So let's quickly check out what's on the losing end. It's a mix between banks and IT. So both the heavyweights leading from the front on the downside. Infosys TCS down over 2% at the start. IndusInd Bank, SBI, a couple of other banking names also under pressure, down 1.5%. Tata Consumer is down over 1% as well. And in the IT bunch, you have names like Tech Mahindra that are also losing steam. By the way, Adani Enterprises, our colleague Vivek was telling us about how they've put on hold their Mundra project. They've suspended plans to raise 14,000 crores for the Mundra project. The stock has had a fair bit of recovery this month, but today it's down about 2.5%. So just keep an eye out on that. What is batting for the bulls this morning? Few and far between, really. It's just pharmaceutical names, perhaps some defensive names. Dr. Reddy's, Divi's Labs in the green. Asian Paints, HUL Titan, a couple of consumption names also a tad in the green, not too much really. But the market is in a bright shade of red this morning. In fact, the Nifty, after a 100-point fall, is not really, stopping in terms of a sell-off. And lots happening in the broader markets too. The mid-cap index too is down almost about 0.5%. So not a good opening at all.
Well, that's right. Not a good opening at all. Sonia, you said it. Well, a few stocks from the broader market that have opened up in the green. You have JK Paper. The stock was up close to 100%. Remember, the management told us that they're guiding for around 6,500 crores for this year, 7,000 crores for next year. Godavari Power and Ispat as well. Mild green is what we saw on that stock as well. Tata Consumer, well, the company has clarified that negotiations with Distillery for the potential acquisition has been ceased. So that stock, in fact, should come up for you on the screen as well. Let's get up Tata Consumer. That's down close to around 1.5%. We have Canfin Homes, new boss coming in after a long while. It was on expected lines, but that's a positive as well. So that's why that one's holding up well in the green. CMAC, they're talking about a bit of a restructuring that they're taking place out there. So that stock as well, I think the initial tick was in the green. And Kochi Shipyard as well, that's the other stock that is in focus today. So a few stocks in the green, but we're getting to a very, very crucial level. A couple of sessions ago, we bounced off 16,950. The bulls will want to hold on to that level. And if they could, maybe risk-reward favors you when the Nifty is down 125 points as we speak. Survey.
Absolutely, Nigel. In fact, Thursday was the low, 16,850, exactly that level from where there was some attempt at a recovery. Let's see if that holds or not. We're about 100 points off it, and this is the morning. And very clear trades coming in. Global-facing stocks and sectors getting completely sold off. So your metal and IT taking it on the chin. And the problem point for the market has been banks, and that hasn't changed. Bank Nifty is down 350 points. The cut on the Nifty is a whole 137, 138 and counting. TCS, Infosys, these are your big names where the pressure is coming in. And mid-caps also taking it sticking to a lot of caution on the mid-cap screens. No sign of bargain fishing or bottom hunting. None of that happening, at least as of now. Caution is what the market is going with. Okay, so as we go through these rates and let this opening settle, let's take the conversation to our market master of the morning, Gautam Trivedi, co-founder and managing partner at Napin Capital, is with us. Gautam, thank you so much for joining in. I mean, who would have thought? We've been discussing this with our guests, right? Deja vu feelings, mini 2008 feelings, call it what you want. But I think one of our earlier guests made a very valid point that the thing is that everybody's a little more prepared. Central bankers, market participants, we as commentators. You tell us, how are you approaching things, watching this entire news flow play out? Because we still have the US Fed ahead. We don't know what's happening with these mid-sized US banks. So given the uncertainty, what's the approach you're taking to the market?
Yeah, good morning, Survi. Good to be on your show. I think the markets are in a very precarious condition right now, even notwithstanding the bailout of Credit Suisse by UBS, that apart. But I think the problem with the smaller banks, regional banks in the US is far from over. If you look at First Republic Bank, for example, that rallied Thursday after the $30 billion investment, but fell as much as 32% on Friday. That stock year to date alone is down 81%. And what's worse is S&P has now cut its credit rating to junk status and has warned that another rating downgrade is possible. So clearly, I think that unfortunately is a problem. There are only so many banks that the US can actually bail out. If you think of all of the US smaller banks, or outside of the top 25 banks in the United States, collectively they account for 70% of all construction and land development loans. So it's a very big element of the real estate sector, which itself is having its own challenges given the rate hikes. So I think there are problems in the United States. And as we all know, whether we like it or not, what happens in the US ends up hurting the rest of the world. And I think at this point of time, given where global markets are, I'd be very careful about putting money incrementally into the market. I think it's better to wait and watch. In fact, year to date, just to underline my point about the fact that the equity markets are so uncertain at this point, year to date, the best performing asset class actually has been Bitcoin, which is up 51%, way outperforming the S&P 500, which is up 2.5%, way outperforming gold, which is only up 4%. So that tells you where the mood is globally for equity markets at this point.
Okay, well, all right. Once we start talking about Bitcoin, you know where things are headed, right? For equity markets. I mean, I haven't heard a conversation about Bitcoin in a while. The fact that you're talking about alternate asset classes. So what do you do then? Because fixed income is another place where perhaps, there's been outperformance compared to equities. Gold has been doing really well. At a time when now the chatter is growing from a mild recession to perhaps a full-blown recession in the US, and then there is this banking turmoil to reckon with. Where do you put your money?
Yeah, here's the thing. I think you brought the point and a very valid point about fixed income. And if you look at over the past about 6 months in particular, and more so going forward, I think fixed income has become a real alternative to equity markets. So since the pandemic, when rates fell as much as they did, the equity market seemed to be the only asset class where people actually could make incremental money. That clearly has not happened. Over the last 12 months, the market in India has been pretty much flat. Year to date, the Nifty is down 6.5%. So when you look at all of these numbers, fixed income today, if you look at Shriram Finance, I was over the weekend looking at, I was on their website, and I found something very interesting. They're offering a 60-month non-cumulative deposit at 8.5%. If you're a senior citizen, you get another 50 basis points. If you're a woman, it's another 10 basis points. So cumulatively, non-cumulatively rather, you end up making an IRR of 9.10%. Mind you, this is pre-tax. If you go on for the cumulative deposit option, it gives you a 10.07%. Now, I think these are very attractive numbers, depending, of course, on what your income tax bracket is. But the fact is, I think fixed income increasingly is becoming a very viable alternative for a whole swath of middle class India.
Imagine that, huh? Nigel, Sonia, Gautam's telling us about fixed income products that are returning 10%. We do live in very interesting times, don't we?
And before that, Bitcoin.
And the Bitcoin guys, I mean, they're the ones taking the argument home, right? That this is the reason we don't need central banks. This is the reason it needs to be a one-on-one, the whole blockchain. Again, a separate argument altogether.
In fact, Gautam, you were one of the first who came on the channel, one of those cautious voices who had warned that real estate as well as fixed income, it could, pull out some money from the equity markets, and you were rather cautious.
Yep.
So good on that call. I recall we spoke in October, we spoke in November as well, and you said we're not out of the woods, be very, very cautious on equities. Some part of that is playing out, Gautam, but you also didn't rule out the fact that maybe we could revisit 15,200 on the Nifty. Do you think that possibility, the probability has increased now, given the fact that now global equities have gone in a bit of a tizzy?
Yeah, it's hard to actually put a number to it, and I don't want to go down that path. But here's the thing. I mean, if you look at, as I said, year to date, the Nifty is down 6.5% in local currency terms. And this is in spite of the fact that domestic mutual funds have bought year to date $8 billion worth of stock. Foreigners, of course, have sold 2.3. But even if you work that math out, the market is still down. So that clearly tells you that maybe it's retail investors that are actually incrementally exiting the market and putting incrementally money into fixed income products, as we discussed. If you look at even valuations, even after a 20% correction in MSCI India, which is now on a CY 24, calendar 24, trading at 7.2 times, which is almost exactly the same as the S&P 500, was still at 88% premium over MSCI China, which is at 9.1 times. So I think there is even now a valuation issue, which is not completely gone in spite of the 20% correction in the market.
Your caution is well taken, Gautam. But let me ask you this, okay, for every incremental 100 rupees you're getting, I understand that quite a bit of it would be parked in fixed income, but how much would you put in equities? And if you do, then what parts of the market? Where do you start nibbling? Because let's admit it, I mean, there is at least the valuations aren't running away like they usually do in the Indian market.
Yeah. So I think, yes, before I answer that, let me caveat that with two problems. We have, as they call it, the I hope I'm pronouncing this right, Damocles swords hanging annually over India. One is what's going to be the price of oil this year, the average price that is. And the second, of course, is the monsoon. So, those are the two issues that I need to caveat every year, every time when I think of where the market will be. But here's the thing, the performance of the Nifty 50 is a little deceiving, because if you look at the broader market, the BSE 500 stocks, more than 60% of the stocks are down 20% or more from their respective 52-week highs. Believe it or not, 184 stocks are down more than 30% from their respective 52-week highs. So yes, the correction is ongoing. I don't think we're done yet. At this point, I would urge investors to be very stock-specific focused. And as stocks fall and the prices at which they wanted to enter start getting attractive, I think that's the time to start building up a position in that specific stock.
Okay, by the way, the market is getting ugly now. So remember, the September low that we hit last year was around 16,818. And we're not too far away from that. We're at 16,968. It's a fall of 130 points right now. So steep sell-off is what you're seeing in the market at the moment. And nothing is spared, really. Bank Nifty is down 300 points. Mid-caps are down 200 points. Looks like, Gautam, there's some basket selling that's happening because, no sector is spared. Banks, IT, consumption, all under pressure right now. This is, 2008 in hindsight was a great time to buy and build portfolios, and I'm guessing this time could be no different. So tell us about some pockets where you would nibble into now. Are you looking at banks in a big way? Are you looking at IT, consumption? Where do your preferences lie?
So, we are in a situation right now where we're actually witnessing a tale of two very different Indias. At one hand, you've got DLF announcing over 1,300 apartments at almost $1 million or more being sold out in flat 3 days. You have Mercedes-Benz that announced that India will be the fastest growing market. At the same time, you have pain in rural India. So two very different Indias. And from that perspective, I think focusing on urban plays at this point probably might be more practical. Again, rural India's performance is a function of what the monsoon is going to be, and that, you and I can't predict that. But fact is, I think banks, as you said rightly, because the FI selling is concentrated along the most liquid names, and no prizes for guessing. It's banks and ITs stocks that will be the first to get hit, and have been hit for the past several months. So I would focus on these two for sure. And I think real estate, if these stocks do have some correction, they've had a good run, but if they have a correction, I would look at that. I would also start looking at cement, given the massive capex by the government of India for FY24.
Oh, cement will be an interesting space then. Any other themes that you like, Gautam? I recall you were talking about Maruti from the passenger vehicle space earlier. Even Bharti Airtel was something that you were positive on. You want to add to that list, and you maintain the positive stance at least on both these two?
I do. I think Maruti may still have some challenges because you have interest rates going up. 70 to 80% of cars sold in India are invariably financed. So there will be some impact on that. But like I said, at the same time, you have a Mercedes-Benz where you have still a 3 to 6 month waiting list. So the high-end premium and luxury segment seems to be in a different orbit. And then there's the rest of India, which is unfortunately or fortunately struggling at this point. So I think I would hold off on Maruti right now, but there are other options within the auto space to look at. We've looked at two-wheelers as well, and we're still figuring out when's the right time to actually make incrementally more investments there.
All right. Just before we let you go, okay. In fact, that was my question, right, on two-wheelers. It's been a big derating that's happened. Even if you look at the last couple of months, right, Hero MotoCorp has lost about, 20% of its value already this year.
Right.
You're looking to invest there despite all the talk about, the possibility of a slow monsoon, the El Nino, the hit on rural markets, all of that?
But no, we're not looking at investing. I think we're studying and closely monitoring that sector because of the fact that the absolute underperformance has been so large that it's a good time to actually look at stuff that hasn't really worked over the past 12 to 24 months. I'm not saying necessarily the two stocks, i.e. Bajaj or Hero MotoCorp are buys. TVS has obviously done extremely well, but I'm looking at the other two underperformers, and we're just monitoring at this point.
Okay, all right, Gautam, we will wrap it up on that note then for this morning. Thank you very much for joining in and giving us your perspectives. That's a lot of caution, and I think caution that's well taken, given the market is doing what it is. The slide is only, deepening, 140, 150 almost down. So it's pretty early, and it just takes us back to the point that we don't know if globally things are done yet or not. One of the reasons, perhaps let's pull up the Asian screens as well, and one of the reasons why the market is still very rattled with all the announcements and all the central bank talk over Sunday night is that you still have to digest this AT1 bond loss. Remember, over $17 billion worth of additional Tier 1 bonds are being written down, Credit Suisse bonds. And that's a loss that markets have to go over. And more importantly, you don't know what's happening with the US. As we mentioned, that First Republic Bank, all the big boys from Wall Street came in, said we're putting $30 billion in deposits. The market's asking, why deposits? Put in the money in the form of equity if you're so confident about it. So these are unanswered questions. We don't know how this plays out. Some buyers have been found for Signature Bank, but not for SVB. By the way, Mr. Warren Buffett's name was doing the rounds over the weekend in terms of him having parlays with the US government, whether he's going to come in as some kind of white knight for First Republic. So I think there's too many moving parts for the market to digest at the moment.
Oh, absolutely. I was reading a report which suggested that almost $17.5 billion worth of credit group AG bonds have now become worthless.
Yeah.
So that quantum is huge if you look at it from a larger perspective as well. $17.5 billion. So what happens with
Sonia? The thing is, markets are connected.
Write-down.
Markets are connected. So if you're going to lose your entire capital on 81 bonds, will you sell somewhere else to make good those losses? Will you shift your portfolios? And that's something that needs to be digested. And markets don't do that in a matter of a couple of minutes or seconds.
Absolutely.
It takes its own time.
In fact, the other thing that we're tracking this morning is the fall that we've seen in Brent crude prices, and it's pretty massive as well. Of course, there are demand concerns. So Brent crude is now at a 15-month low. It's already down about 15% in 2023. But what this means is it could be lower costs for a lot of the crude consumers, like paint companies. So let's find out more about that. We have Abhijit Roy, who's the Managing Director and Chief Executive Officer at Berger Paints, who joins in to give us a view on how the business is shaping up as well, given that there is an expectation of a weak monsoon. Do you think rural markets will recover? All of those questions. Abhijit, good morning. First, I just wanted to understand what proportion of your raw material prices are crude linked, and given that we've seen such a steep fall, have you seen a proportionate decline in raw material prices, and will that help you with your margins? If you could give us a ballpark number on how much that could help in FY23 itself.
Yeah, so a significant portion of our raw material prices are linked to crude and crude derivatives. So it's not necessarily just plain crude, but also the derivatives of crude like monomers, etc., which come out of crude only. So that part is dropping, but the impact will be felt much more in the first quarter of next year. This quarter also we will get some benefit, and that will come through.
So when you say benefits, you've been doing about 13-14% margins, right? Do you hope to stay in that band itself, or do you think that there are some levers, operational levers, which could help you move out of that band on the upside in FY24?
So 13-14 was an aberration which happened in Q3 or just before that. It will come back to normalcy. We normally operate at around the 16 to 17% level. So that will come back. The gross margin at least had dropped down to about 33-34% from the 37-38% which we normally operate in. So that will come back to about 37-38%.
All right. Hi, Abhijit. Good morning. You told us that 37-38% gross margins you're expecting in Q4 towards the end of this itself. So that's on course, right?
It should be, yes.
Okay. And when do you recover to margins of 16% odd from the current levels? Which quarter do you see that happening? Gross margins, high 30s, And EBITDA margins recover by when?
If it reaches 37, 38, it should be around that 15.5, 16% of EBITDA as well.
So that's possible in Q4 then?
It is possible in Q4, and going forward in Q1, it will be slightly better than that.
Okay, the other part of it is when input costs cool off, it could result in your pricing power as well becoming less, because your customers will say, hey, you're getting the benefit of lower crude prices or crude derivatives. Why don't we as well enjoy lower prices? Is that a possibility? Will you see these price increases that have been taken getting pulled back a little bit?
So as of now, it doesn't seem like that. Two reasons for it. One, these prices are always volatile. Today it has dropped, tomorrow it may again go up. Some war might erupt somewhere. The prices of crude has been fluctuating. It's come down now for the last 6-7 days. Doesn't mean that it will stay at those levels. So we have to watch and observe. The second part of it is related to the fact that we did not take the full price increases when it was happening. There's still some room left for taking price increase. We didn't want to overburden the consumer at that point of time. So there is no, therefore, need for dropping prices at this stage.
That's interesting, Mr. Roy. So are you going to take those price increases, or are you going to hold the line for now?
It depends. As of now, it is being held back,
Okay.
but if prices start climbing a little bit, we may have to take the price increase as well.
Okay, so, that brings me to the bigger question that I have on my mind, and that is demand. Help us make sense of things, and this is something that people in the market are really beginning to notice. Obviously, you have DLF selling houses for 7 CR. Now, we don't know how much that lasts or not. There's also that budget tax factor, right, on luxury housing. So we don't know if it was aided by that move. On the other side, there are companies that are talking about consumer demand. I keep going back to a statement that Maruti made to us last week, stating that there's a bit of a hesitation in terms of new inquiries and bookings right now. So, Mr. Roy, in terms of pure demand growth, as of now, what have you seen in the fourth quarter, post the festive season? And more importantly, given the headlines, the news flow, the inflation concerns here in India, could demand be at risk at all in the first quarter?
So inflation has been a concern, especially in the rural areas. There was some problem there, and that was being felt, in the third quarter much more so. In fourth quarter, in the month of February, it suddenly improved, and the rural demand picked up, possibly to good levels actually, and then that helped the companies to possibly grow at a faster pace. So January, February has been good months for us. Demand has been back to normal almost. March also so far looks good. So fourth quarter should be reasonably good. We should register double-digit growth rate.
Okay, so you'll reach double-digit growth in Q4, right? That compares to about a 6.5% growth in Q3. So there's an improvement. Are you also looking at double-digit growth for the full year of FY24?
Yes, Sonia, and so that looks probable as of now. Of course, time will say what happens. But Q1 definitely, we should look forward to that, and then going forward, of course.
Okay, so when you talk about double-digit, right? Are we looking at what, mid-teens, high teens? How good is demand? Because I know things are all over the place right now with the monsoon situation, which nobody knows which way it could go. But are you looking at, high teens, mid-teens growth for FY24?
Difficult to predict, because this El Nino thing has to be sorted out, because as of now, it looks like that, we will be in the 12 to 13% range in terms of volume growth. And that's where we are pegging as of now. But it may change, depends on how situation is. It may improve, it may deteriorate, but as of now, we are baking in a percentage growth of about 12 to 13% in terms of volume terms for next year.
12 to 13%. I think your investors would really like the sound of that compared to, the trends that we've seen in the past. Just a question. When you're talking about the revenue pie, Mr. Roy, what is the breakup between your premium segment and let's say the mid or entry level? And I'm just wondering if you are experiencing or if you're anticipating any down trading at all.
So it's about 25 odd percentage in the premium luxury segment, and the luxury segment, what we call it, and just below that we have a pre-lux category, which is similar to luxury. So that's about 25 to 26%, and then the economy category will be significantly more than that. As of now, no significant down trading that we are seeing. There is some marginal shift maybe in certain markets, but the premium luxury category also is doing well.
All right, thanks a lot for joining in. We will leave it at that. That is Berger Paints talking about demand picking up, and they're talking about a 12 to 13% volume growth for FY24. That's decent. After what you've seen, they're targeting double-digit growth in FY24, 12 to 14%. Well, let's slip into a quick break. On the other side, we'll get another global opinion going. Harold Vandal of HSBC will be joining in for some market talk. We'll also connect with Ashish Bhandari of Thermax to discuss their foray into the green hydrogen